growing your business can mean big-time logistical questions like, how are we going to keep up with all these local deliveries? Let Uber Direct offer you a helping hand. With Uber Direct, you take orders on your website, app, or by phone. Then drivers who are part of Uber's courier network pick them up from your store and deliver them to your customer's doorstep. Sounds simple, right? Delivery just got better with Uber Direct. Learn more at uberdirect.com. Hello, this is Jonathan Mays, Editor-in-Chief of Restaurant Business, and in this week's episode of A Deeper Dive, I speak with Mathew Focht, the founder and managing partner of the investment fund Emerging, to talk about it. Emerging is a fund that invests in small technology and restaurant and entertainment concepts. He agreed on relatively short notice to join the podcast to talk about Topgolf and what Topgolf's issues say about the food and game sector. Topgolf is one of the biggest names in that sector. The company thrived coming out of the pandemic. It was sold to the golf equipment maker Callaway brand in 2020, and the next year, Callaway added Topgolf to its corporate name as the chain sales went through the roof. But those sales have fallen more recently, prompting Topgolf Callaway to propose a spinoff of Topgolf. Meanwhile, another food and games concept, Pinstripes, is cutting costs as its own sales fall. We talked with Mathew about these issues and what they mean for Topgolf, but also the emerging food and games sector, which is still receiving considerable interest from investors. Mathew and I talk about this as well as the overall state of investing in the restaurant space. We're talking Topgolf on A Deeper Dive, so please check it out. Okay, I am here with Mathew Focht. Mathew, welcome to the podcast.
Thanks, Jonathan. It's good to be on with you.
So tell us a little bit about yourself and your background before we jump in to the...
Sure. So for over 20 years, I've been working with restaurant entertainment concepts as well as a lot of technology in the space. It's where my passion has been. And I was building data strategy the early days, building strategy for expansion of these concepts led to me investing in these, a lot of technology enabled concepts. I started a supply chain company called Buyer's Edge, the division of that company today, Consolidated Concepts, with a partner of mine, John Davey. And then we just launched a fund this last year called Emerging, and we're investing in two things that we love doing and love working on, and that's technology and concepts that are tech-enabled.
Mm-hmm. What kind of... what stage concepts are you looking at?
We love to come in like 1 to 6 units where they really haven't done much damage, and there's a much incredible upside of building strong brand equity. We're great. We're really good at finding concepts that have big white space potential. And also deliver, we think, tremendous value to the market in their neighborhood or their that MSA. Also, landlords have a tendency to find a way to make these concepts more attractive with their mixed use projects today that are being built. So create that sense of community, and that's a lot of the social entertainment concepts that we're investing in today are extremely attractive because they're friendly to the families, they're friendly to the late night business, and this generation today, we're in an experiential economy today, and that's really what we're delivering on.
Mm-hmm. So now this is are there a lot of I don't get the sense that today. These days, there are a ton of investors in the space right now. It seems like a lot of the investment community sort of backed away from the industry. And I know you're sort of a specialty fund, but it seems like a lot of investors have sort of backed off a little bit. Or are you seeing a lot of other investors out there?
No, I think you're right. To be frank, it's a tough market to be raising capital. I don't care what specialty or how niche or how broad you are. It's just a tough market. There's a lot of money sitting on the sidelines. And a lot of the vintages from 2015 to 2022 are just getting their 1x returns. So they're just getting their money back. So there's still a lot of money in recent raises sitting on the sidelines waiting to be deployed. But we've been fortunate. We've got, we have today about 84, we have 84 LPs, investors in our fund. And, we've raised, and we're on a path to $100 million by the end of the year. And we're fortunate to make 13 investments. We just approved 12th and 13th investment the week before last. And, these companies we're investing are rocket ships. They're huge EBITDA margins traditionally on the concept side, 20% plus. And on the technology side, I don't mind these little downturns or when the market moves sideways, because people pay attention to the bottom line a little bit more. When things are flying all the way up to the right, it's all top line conversations. But when you got to address your bottom line, technology is making a significant impact.
Mm-hmm. Yeah. I remember I was talking to another investor not that long ago, and they were saying that now is actually a really good time to be getting into the business of investing in these types of concepts. The brands that have sort of established themselves at least a little bit before they've done any damage to themselves, to use your quote. That they were saying this is actually a really good time, because frankly, by the time you've invested in these companies, they've started to show some growth and that sort of, in the time that it takes between, like, if you invest in a concept today, it's going to be 4 or 5 years down the road before they show the type of growth that you're looking for. And at that point, the market could look very, very, very different. Because, these investment cycle, this is a cycle. Eventually, once the industry looks better, all this private equity money is going to kind of rush back in. Probably too much, if you want my opinion, but they'll rush back in. And they were saying that this would probably be a pretty good time to actually invest.
Yeah, I think it is. We're seeing more reasonable valuations in the technology side. On the concept side, funny enough, the valuations are holding pretty strong, because there is a big appetite for better social entertainment concepts, for competitive social entertainment concepts, and that's what the market wants. I mean, but if you're a casual dining or fine dining, it would be seriously tough. QSR, fast casual, obviously the industry's finding value in those early stage concepts, and I think those concepts are attracting capital. But when you look at social entertainment, if today it's easy to get a better quality menu item or getting a better elevated drink at these concepts that it didn't exist 5 years, 10 years ago at all. It was the Dave and Buster's, nothing wrong with Dave and Buster's, but you weren't going there for the food. And now the veto votes are, the veto votes from the family members or the wife or the girlfriend aren't there anymore, because they can get a better experience with elevated food and beverage.
Mm-hmm. Yeah. I can't believe you said nobody goes to Dave and Buster's for the food. Wow.
Well, maybe they do. There's a special character. They are selling some food there. So
yeah, well,
I don't know
they have had.
I don't think it's the main reason why they're going.
They have said in the past, they have a previous iteration. I think current management's have been trying to upgrade the food, but previous management of Dave and Buster's has basically said on earnings calls that that's not their main focus, because why would they? They're publicly traded and all their profits are coming from the entertainment side of the business. But obviously, given the level of competition, you can't do that anymore. And people have higher expectations, and they're going to want better food for sure. So let's talk about one of these brands right now, and something you recently wrote about, which is Topgolf. And, my big concern is that Topgolf is revealing broader problems in the entertainment sector. Topgolf is being spun off by Callaway, most likely because Callaway can't find a buyer. This happening 4 years after Callaway acquired the brand, 3 years after they were so thrilled with their purchase that they renamed the company, and now they're selling it. So my question to you, number one, is what does this say about that particular sector, generally speaking? And number two, Do you believe, Callaway, that this company still has runway for the growth down the road?
Yeah, I mean, I think it's funny enough. I think this is getting a wrong spin, and it's really kind of perplexing in a way, but at the same time, it's classical business case model in a sense that Callaway since they purchased Topgolf, their stock in the market cap has shrunk to about a third. Which is they were in March of if you look at the dates and you look at the market cap, they were at one time $6.5 billion company in March of 21. Now they're 1.8. I didn't look at it today, but they're trading about 1.8 billion and 1.9 billion, and so you've lost huge market cap valuation. And so when you have this you've got the market is telling you that these are two different companies, and we're not going to give you the benefit of the synergy of these two companies come together. That was once thought to deliver obviously value for the shareholders. And so what you have is you have a high growth company, 50% EBITDA margin with Topgolf. You have the equipment business, and you have a 20% plus EBITDA margin with Topgolf. But you have two major different growth trajectories. The equipment business has been decreasing, and Topgolf has been increasing revenue with store count, but comp sales now they're playing into the story of comp sales have come down. And comp sales are decreasing, 8% decreases. Where the reality is, if I just took the data I looked at Texas because I love looking at Texas data. We have a data science team that looks at mobile data every week. We look at point of sale data. We look at spend data. We collect data on almost 1 out of 3 restaurants and purchasing data in the U.S. And about a third of the U.S. market we have access to. So we see a lot. There's a lot that we're tapping in terms of data, and we're trying to make these decisions and look at things. But I can tell you, Texas data, because of alcohol sales, are very foretelling because it keeps everybody in the same benchmark. And it's interesting. Everybody is down first and second quarter, and they're giving up the gains from 2 years ago. And it is the gains of like these companies. If you look at Topgolf in 2021, they were up. Their sales were up 33%. And so if you compare it to year over year now, they have given up some of those gains, and they're still comped 13% higher in sales alcohol volume since 2024 to 2020. So Dave & Buster's, same thing, big spike, 50% plus spike in 2020, and have given up all those gains for the most part. But not at the same level, but pretty close. The same trend line. Main Event, same thing. They've given up a lot of those gains, and Dave & Buster's is probably the best out of if you look at most of the social entertainment space. I think because there's a value play there, and their customer is it's not considered such a premium purchase, and which I think are or premium price point, which Topgolf does get impacted, and they're also getting impacted a little bit more. The corporate business side of things, because corporate spending is down, obviously, and that makes a lot of sense, right? But they're about 5% down, and I don't think that's going to recover anytime soon. And it's also the pretty shiny penny thing is coming off a little bit with Topgolf because there's a lot of competitive social entertainment coming into the space. However, they're holding their own, and this concept is the growth engine, and it is a very different concept or different company than an equipment company. And so the market doesn't think they belong together. It's shrunk by a third, 2/3. So I think this is a classic case of the company's taking an opportunity in the market when there is a little bit of a trend downturn, giving up those gains from way back post-COVID sugar rush days, to now, hey, let's spin. We have the momentum. This is our right time. Let's spin these companies off.
Yeah. Yeah. Well, they're certainly not the first company to get enthralled by temporary sales growth. And we can't. I think it's probably fairly unrealistic to have expected companies like Topgolf or Dave & Buster's, for that matter, to continue to do what they did, in 2021, for instance. I think that was an unusual period in the restaurant space. I mean, people were unleashing pent up demand. And I think Topgolf in particular was one of the big beneficiary. Everybody wanted to do something. They were they were like, oh my gosh, I'm out of the house now. I'm going to Topgolf immediately. And
exactly.
And now, they're sort of coming back to earth. I mean, I think the thing that I'm more concerned about, but not really from Topgolf's perspective, is that decline in business spending, but mostly because of what it might say about the economy going forward. Like if you said businesses are cutting back on these type of things, a few sales challenges or issues going forward, you can kind of see them cutting back on, starting to lay people off and yada, yada, yada. I'm a little bit more concerned about that. But, companies have these, you're right. A lot of companies are coming down off of their post-COVID highs. Topgolf is not remotely alone in that.
And we're seeing, we're super excited about some of the other concepts that go into market, and we're seeing great numbers in the competitive social entertainment space. So this is not I don't think this is being perceived as a potential view, like what's happening in the industry, competitive social entertainment concepts, or this entertainment in general is taking a big hit. Casual dining, fine dining, I think is really the concern, in my opinion. And QSR, getting a Chipotle burrito, there's value in that burrito. That's not going away. But you look at sitting down for a 2-hour meal, if you're fine dining, and you have an option, to go to a putt shack, or we have a Formula One F1 arcade new concept, which is doing incredible numbers. We just opened the first one up in Boston Seaport in April. This concept in London, it's real simulators. It's backed by Liberty Media, who owns F1. We're an investor. We're getting ready to open up DC and announce Vegas, and got a heck of a pipeline there. And that's like simulated race cars. You get great food, elevated cocktails. It's an awesome environment. So we've got a bunch of these in the pipeline. The founders of Topgolf actually have a new concept called Pool House that hasn't been out there, hasn't really been talked about yet because it's kind of on the down low. But we're most likely investing in that. We're doing our diligence, and it's transformed the oldest game in the business, playing pool. And it's probably not as old as golf, but it is one of the old ones. But what I love about it, it's such a wide addressable market. Anybody can play pool, and this is using technology. Even it tells you, like, when you're online, it takes a red line when you're off an angle to when you're on the angle, it turns green. There's a line that projected down onto the table. And it just transforms the game. A little bit of technology totally transforms the game of pool. And it uses algorithms to handicap if you're a really amazing pool shark player and the other person isn't. It forces that other player to make that better shot versus take the easy one for the same points that you get to some. So there's some really cool stuff going out there that I think these competitive social entertainment concepts are hitting stride. I didn't like to see the Topgolf kind of deflating potentially this industry that is, I think, the bright spot in our market today.
Mm-hmm. Yeah. Is it just, how much do you think all this competition, because competition is influencing Topgolf? I mean, we've had to your point, there have been a number of these entertainment type concepts that have emerged. There's somewhere like 500 involving pickleball. The Topgolf founders they've been putting their technology into a couple of different games because they've been behind Putt Shack and so they've been doing some really innovative things by putting computer chips inside balls apparently. So I mean, how much of this competition is creating issues, you think, for Topgolf, or do you think that there's just more out there?
Another thing that's interesting about Topgolf, you naturally improve your game. It's one of those games or one of those experiences that where you get a real golfer to go to Topgolf. And you do, in some occasions, you do. But 60% of the people have never been to a golf course or played on a golf course that go to Topgolf. That's a stat that they talk about. And that's interesting. So it's a very hybrid, broad experience, but nobody's going to Putt Shack to improve their putting game. And at least I don't know that. In the first days, it was funny when we opened up in Atlanta and Interlock, somebody did come up with their shoes, brought their golf shoes, but I don't think that isn't happening today. I don't think anybody's going to F1 to prove their skills on the race course to drive a Formula One, car. It's simulators, but so there's this thing out there that I think if it's a broad market appeal, the best social entertainment concepts have broad market appeal. But also, if there's ability to improve your game, I think there is you have a little bit of resilience that these other concepts don't have. And we just invest in this company called Batbox, which has the same kind of the stick that Topgolf has. You're swinging a baseball. You can adjust those speeds. You are improving your eye-hand coordination when you're in the batting cage. There's balls coming out, flying at you. It's a true batting cage, but it's elevated. So we think there's a little bit of benefit that Topgolf has that they're going to be around. And I don't think all these social entertainment concepts are going to beat and comp them down. I think they're here to stay, and I think they're just going through a little bit of a giving back some of these gains that they had in those COVID recovery years.
Mm-hmm. But wouldn't there be some competition for the business? Do you think for the business customer? It seems like the biggest problem with Topgolf from a sales standpoint was, their same store sales from large customers, from the business, business customers, event type things, was down with 27% on a 2-year basis. So they've lost more than a quarter of it's now down below where it was pre-pandemic. Is that, and that's kind of a key group for a lot of these businesses. Is there enough of that business to go around, or do you think this is purely cyclical?
Well, I think there's definitely more pressure on that corporate business than ever. There's less of it. And a lot of these businesses are built today. They're generating huge revenue. It's a whole new day part. That corporate business from 1 p.m. to happy hour, 1 to 4 is a lot of margin. A lot of margin is built in these concepts there. So it is getting more competitive there, no question. And I don't know, in a shrinking market, how long term Topgolf you're going to see the impacts of that. But these Topgolf numbers, their AUVs have continued to trend the right way. They've increased in volume. Their margins have gone, with less traffic, they've been able to find some efficiencies to drive EBITDA margins or drive their incremental cost down. So I think ultimately they're going to have to get sharper and smarter because it's going to be more competitive, to your point. But you're building a 20 million plus venue with a very unique experience. And I think, the average social entertainment concept is not providing real competition to that, on any high level.
Right. Well, they still seem to, until relatively recently, we're getting more actually individual customers, some small groups, which is one of the things that they've been making an argument of like, hey, like this group is doing fine for the most part, not entirely. And more recently, they've kind of fallen off a little bit, sort of like most of the restaurant industry. So that's kind of their argument. But, if they're going to rely on business customers, that's something, to your point, they're going to have to make sure they sharpen it going forward, because that's it is getting more and more competitive in the near future. So
yes, for sure.
Yeah. And so all right, sir, this was fantastic. I really appreciate you joining me this week on the podcast.
Great, Jonathan. Thanks for having me. Enjoyed it.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Spoons, artwork by Nico Hines. You may find this and other episodes of the podcast on our website at www.restaurantbusinessonline.com/article/deeper-dive. And you may subscribe on Apple Podcasts or Spotify. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening. Growing your business can mean big-time logistical questions like, how are we going to keep up with all these local deliveries? Let Uber Direct offer you a helping hand. With Uber Direct, you take orders on your website, app, or by phone. Then drivers who are part of Uber's courier network pick them up from your store and deliver them to your customer's doorstep. Sounds simple, right? Delivery just got better with Uber Direct. Learn more at uberdirect.com.